Welcome to Zitron Squeeze, where one partnership is starting to look like a balance sheet story. The headline here isn't just that AI is expensive, it's that one customer-partner relationship may already be large enough to shape how we read Microsoft's entire AI business. And once you look at the disclosed revenue mix next to the scale of capital spending, the obvious question is whether this is proof of strength or a warning about concentration. The core fact pattern is pretty stark. Based on Microsoft disclosures and Bloomberg's analysis, OpenAI-related compute spending and revenue sharing accounted for at least 70% of Microsoft's fiscal 2026 AI revenue. If that estimate is right, OpenAI isn't one important AI customer among many. It's the dominant disclosed contributor to that line of business. There's a second number that matters even more outside the AI narrative bubble. The same estimate puts OpenAI-related revenue above 7% of Microsoft's total fiscal 2026 revenue. That changes the frame. We're no longer talking about a flashy strategic partnership that matters mainly for future positioning. We're talking about something that may already be material to Microsoft's company-wide financial results. Revenue concentration cuts both ways. On one hand, it can be exactly what early platform shifts look like. A breakout customer drives demand, proves the market, and helps absorb the cost of building infrastructure before a broader customer base arrives. On the other hand, concentration can make growth look broader and sturdier than it really is. If one relationship carries most of the disclosed AI revenue, then claims about diversified enterprise demand need to be read carefully. That's where the distinction between confirmed fact and narrative matters. The confirmed part is the estimated revenue concentration. The narrative leap would be assuming that means Microsoft's AI business is weak, or alternatively that it guarantees durable dominance. Neither conclusion follows automatically. What it does support is a narrower point. A meaningful chunk of Microsoft's AI story appears highly tied to OpenAI's activity, economics, and continued willingness to keep running a lot of workload through Microsoft's infrastructure. There are a few plausible readings here. The bullish reading is that Microsoft backed the right horse early, and the concentration reflects successful execution. If the most important AI lab is spending heavily on your platform and sharing revenue with you, that is a real commercial advantage. The more cautious reading is that a strategic partner can also become a dependency. If one counterparty is this large, its product roadmap, bargaining power, and technical choices start to matter to your own reported success. That doesn't mean the relationship is bad. It means the risk profile is different from a business built on many smaller customers with lower individual leverage. And there's a subtle accounting and storytelling issue here too. Investors and observers often hear AI revenue and picture broad market adoption. But depending on how much of that revenue comes from one intense bilateral relationship, the underlying reality may be more concentrated and less representative of general demand than the headline suggests. Then there's the other giant number in the room. Microsoft reportedly spent $261.3 billion in capital expenditures over the referenced period. What that clearly tells us is that the infrastructure build-out behind the AI strategy is enormous. Even without a perfect breakdown, this is industrial-scale spending. What it does not tell us, at least from the excerpt we have, is the precise time period. How much of that CapEx is directly attributable to OpenAI-related demand, or how much supports Microsoft's broader cloud and AI ambitions? That missing context matters a lot. CapEx numbers can sound conclusive when they're not. A huge spend can mean disciplined long-term positioning, overbuilding ahead of uncertain demand, or simply a mix of many infrastructure priorities being bundled into one eye-popping figure. It's tempting to line these numbers up and say Microsoft spent $250 billion to support an AI business heavily reliant on OpenAI. That may turn out directionally true, but the source material here doesn't let us prove that exact relationship. What we can say is more limited and more useful. Microsoft appears to have made extraordinary infrastructure investments during the period in question, and OpenAI appears to be a dominant disclosed source of AI-related revenue within that same broader strategic push. The open question is whether those investments are building a diversified future business, or whether present economics are being disproportionately validated by one exceptional partner. That's the trade-off to watch. Concentration can be rational at the start of a platform shift, but it also raises the threshold for proving that demand is broad, sticky, and defensible beyond the flagship relationship. If you wanted the optimistic case to get stronger, you'd look for evidence that non-OpenAI AI workloads are becoming a larger share of revenue and that the expensive capacity build-out is attracting a wider set of durable customers. If you wanted the cautious case to get stronger, you'd look for signs that growth remains tightly coupled to OpenAI's spending patterns, or that returns on infrastructure are less impressive once you strip out that relationship. Right now, the better supported claim is the narrow one. OpenAI seems to matter an awful lot to Microsoft's disclosed AI economics, and the infrastructure commitment around AI is massive. Beyond that, the biggest conclusions still depend on context we don't have in this excerpt. That's the story for now. Big revenue, bigger infrastructure, and a partnership whose scale may be more material than the usual AI framing suggests. Thanks for listening to Zitron Squeeze. This episode was generated by Podkey. Create your own at podkey.fm.